September 5th, quick one-up video for you wonderful ladies and gentlemen, although I am filming this at about 3 a.m. late night on Monday, early morning Tuesday. Bit of a bounce attempt today. It failed. It ultimately did rebound into the end of the day, although we are now down in after hours. I was noticing in VIX they got the run back up to the channel high that we had been anticipating, but weren't able to close it or hold it back up over the 200 MA. I think the bears need to hold 1778 plus, which is of course the 200 MA, for still higher volatility and still lower prices in the market. Anything below there I think is status quo with sideways muddling around. I was looking at the ES and NQ and we're still seeing the head and shoulders pattern playing out. We do have a mini inverted head and shoulders on the ES, but I think it needs to clear high of day, at least 43.79.5 to 43.83.5 to get going to the upside. Anything below 43.57 quarter, which we're now below, is a little iffy. Increasingly more so below 43.47.75, and then I would say even at more outright bearish below 43.38 quarter, which is of course low of day. I think if that were to take place, we're on course for the retest of 4,300, where there would likely be more support. Q's similar setup. Bulls need to clear 14.946 quarter to 14.95575. Anything above there I do think could continue still higher. Anything below 14,842 half is more bearish. We're a little bit below there now, and I would get it increasingly more so below 14,792.75 to 14,782 quarter, particularly that 14,782 quarter because that's kind of the low of day and it was a little bit poor. If we do continue lower from there, we likely would come down to 14,537 half-ish. On the upside, if we are able to clear, we could probably get back up to 15,043 half. On the ES, if we clear that 43.83 half, we probably can get a retest back up to close 4,400 to 44.14 half, and then we'd see if that could clear. Then, you know, we've got a big runway up to 44.62 quarter to 43.8375 to 44.85. I do think that area would be some pretty stiff resistance now and a great short opportunity. As far as SPY goes, we got down to one of my big targets of 429.61. There's a little bit lower possible for the channel low at 427.65, but anything that remains below 433.01 is suspicious to me with sideways to downside potential. The first big downside target would be the gap fill from 6.1, which is 421.82, then 418.31, 414.05, and then 410, and then lower into the 400s like 406s and 402s. But I do think that that 418 to 410 area would be a big opportunity to cover shorts and look for a reversal play back to the upside. I think if the bulls can clear 433.01, there is potential for the 920 gap fill up at 438.43, but then I see there being massive resistance into 442.75 to 445.22, where I'd be looking to short again. As far as the Qs go, a similar setup here. We didn't quite break the reference low like we did in the SPY at the 818 low, which was of course 354.71, but we are hovering around the 100 MA and a little bit below there. If we were able to clear high of day, and I think really clear the 100 MA here at 361.40, we could fill in that 920 gap there to the 364.54. The real big meat of the resistance, if it does rally beyond there, comes in at 369.15 all the way up to the 372.74, which is of course the Jackson Hole high of day. Generally speaking, if we're below the Jackson Hole high of day, which is of course the 824 high, I'm leery in everything. Market's been keying off of interest rates and bonds. TLT is getting that obscene number like we had talked about. I think that there could be some room down to 88s and maybe even 86.68, which would be the 2 times range of the last measured move. If that were to continue to break, I mean, we could get really crazy, and we'll talk about that if it would get there, but I'm not really quite in that camp just yet. I do think if we rally back into the 93s to 94s, that will be resistance now because it had been prior support. If interest rates continue on this path of higher interest rates, the pain trade, higher dollar, it could be problematic. I think we might get some answers on Friday. We're expecting a PCE number, but it is expected to be higher than the prior read, which is of course problematic. Fed isn't expected to go here in November. If anything, the probability of that has been decreasing, which is odd because rates have been going higher. Although the December potential is still there at about 34%. That's decreased a little bit too, but if anything, we've seen the market catch up to the Fed. And Powell did say proceed with caution, so that had me thinking November is off the table, but December, they could squeak it in there. 2 years still well above 5%, 5.15%. Anything above 5% to me remains problematic. Back below, maybe there's some breathing room. And it seems like the 10-year may be moseying on up to 5%. We're at 4.558, and that could squeeze up a little bit higher. Rates are going to be the big story. I've been warning about this. We kind of need to see that little bug in the corner on CNBC with TLT or some interest rate, and then that will be getting to near the end. They may even be doing it at this point, but I'm a cord cutter, so I wouldn't know. And I suspect they're not just yet because I'm first starting to hear the dunces on TV finally acknowledge this. Fear is coming in a little bit. Inflation is rising. Growth is slowing. Auto worker strike, although the AFTRA strike, the AFTRA-SAG strike for the Hollywood workers is ending, so that is a little bit constructive. But generally speaking here, I don't think the market is really going to be able to find sustainable rallies until we see interest rates cool off, either go sideways or lower, meaning bond prices start to rally, the dollar back below 5, and really 104.636, but I haven't really seen that yet. If anything, we're into the 106s on the way to 107s and maybe even all the way up to 110. That would be the pain trade. Remember, markets don't end at fair value or where people think reasonable. They often go to extremes and excess out of necessity. You have underlying conditions and people who are wrong who are fueling that. So it does seem like there might be a little bit more to go in that. I don't know that it's a huge amount, but there likely is a little bit more. And I am cautiously optimistic that we will get a really great opportunity to start piling into some yield plays. I've mentioned anything below 93. I don't mind starting to nibble, but now that we're down to that obscene number, like I said, below 90, I start getting interested closer to 86s here, and even maybe right here if you want to start selling some out-of-the-money puts. Again, very small size, though, because things could get a little bit crazy, and you never know where things end. Trying to feel for the bottom is very different than making a huge statement purchase with catching a falling knife. We're looking to play for bounces, not necessarily for gigantic positions. I do think that would be for the next year play, when I do think if we run into some recession, we could see some rollback on yields. The Fed, of course, shocked the market by saying that they might do another interest rate increase this year, which was kind of expected. But the fact that they took back the potential for 2 rate cuts next year, I think roiled the markets and has people really on the edge here of thinking higher for longer. And that is now, I think, consensus in the lexicon. So we would need to see, I think, growth really plummet, unemployment really spike, or some kind of signal out of the Fed, but none of that would be positive in my view, at least for PE multiple premiums. Maybe some short-term relief, but it would be for the kind of wrong reasons. Oil is still too high, pulling back a little bit, but I think that's a global growth scare because people are realizing these higher interest rates are making people have to pay for more things like utilities and higher mortgage and higher credit card debt, and maybe less to spend on things like sneakers. We've been seeing Nike make new lows, and maybe luxury expensive goods, which hasn't really hit yet, but that could at some point. We've seen the retailers just generally get smashed. Seasonally, this should be the strong period for retailers going into Black Friday. It was sell Rosh Hashanah, buy Yom Kippur, so if the bulls are going to put on a rally, it would be here. If not, it likely would come closer to Halloween. That's it.